Hello, my name is Zach Shields, and I'm a member of the Dole Institute Student Advisory Board. Welcome to the Dole Institute of Politics, and thank you for attending today's presentation. The Dole Student Advisory Board is composed of KU students committed to the work of the Dole Institute. We attend regular meetings, assist in events like this, and plan an SAB-sponsored program every semester. Members of the SAB receive great opportunities to network with our special guests. If you're a student and would like to join, please contact the Dole Institute. The Dole Institute would like to hear from you. If you enjoyed today's program, please let us know by contacting us on Facebook, Twitter, or through our website email. Your attendance and feedback help shape future programming. To view past programs, visit our online video archive at www.doleinstitute.org. A video of today's presentation will be available soon. Before we begin, I'd like to remind you to please turn off your cell phones. Smartphones work too. After the interview, we will have some time for audience questions and answers. If you have a question, please raise your hand and a student helper with a microphone will come to you. Please ask just one brief question. And now please welcome Dole Institute Development Coordinator, Clarissa Unger.
Thank you, Zach, and thank you all for coming out today. As Zach said, my name is Clarissa Unger, and I'm the Development Coordinator for the Dole Institute, which also means that I get to run the Friends of the Dole Institute program, which is a great program for any of you that don't know about it yet, as a way that you can help support the Dole Institute and help us continue offering public programs like the one you'll see here today. I wanted to let you all know that we do have a special offer for anyone who would like to join the Friends of the Dole Institute from now through March 1st. We are offering a signed copy of Unlimited Partners, signed by Bob and Elizabeth Dole and Richard Norton Smith, for anyone who wants to join at the $100 Friends level and above. So I will be in the back after the program today if anyone is interested in finding more about our Friends program. And I see that we have a lot of our friends here today already, so if you would also like a book, we are offering them for $50 for anyone who is already a friend. And with that, I will turn it over to our director, Bill Lacey, to introduce today's guests. Thank you.
Thank you, Clarissa. Thank you all for coming out this afternoon. We're very excited about today's program. It's something that we've been working on for a few months, and we were delighted to get it set. And as we were joking a little bit beforehand, delighted that it just happened to be scheduled almost accidentally today in the middle of two big snowstorms. So we could actually go ahead and continue the program, although that was in some degree of question Thursday night, I must say. Thank you all for coming out. Our two panelists today who are going to discuss this very important topic of Kansas state tax policy are Secretary of Revenue Nick Jordan, to my far left, which I don't think he actually is, and Senator Tom Holland to my left, who probably is. But anyway, please welcome these gentlemen.
Thank you.
Thank you both so much for taking the time on a Sunday afternoon to come over and help inform people about this important policy. Let's start, Secretary Jordan, with you. Could you kind of outline the key changes in both last year's and this year's policy and what the administration, what kind of benefits that you think that they will achieve?
Sure. Bill, I want to thank you too for inviting me and everybody for coming out today, and it's good to be with Tom. We've been friends and a lot of respect for each other, so it's good to be here with a friend. Even though we might disagree, we're not like Washington, D.C., we can still be friends and are. And Bill, does that mean you're to the far right of me?
I don't know to the far right, but...
Okay, good. Bill, thanks. The governor was pretty clear when he was running for governor several years ago, which Tom will remember well, that he wanted to lower taxes in the state of Kansas. He had a roadmap for Kansas at the time, and what he had stated in that roadmap, two goals that probably really relate to tax policy is he wanted to increase the net income of Kansas families, and he wanted to increase the private sector employment in Kansas. I'd say there's a third point that we talk a lot about in cabinet meetings and among ourselves, and that's capital flow in Kansas. We're not a big venture capital state. I've done a lot of work in the past. Tom's done some work. on trying to increase our biosciences, our high-tech industry, some things that hopefully are now beginning to attract some of the venture capital attention in Kansas. But for years we've not had capital flow, particularly for small businesses who, as you know, the Small Business Administration, everybody else has quoted as saying that 75% of your job creation comes from small business. And small businesses are very important to the state. So the governor, first off, we sat down and we said, you know, where do we start? Where do we work on growing this Kansas economy? And the first idea we came up about, I was on the transition team at the time, and the first idea we came up with was what we called rural opportunity zones. And I want to talk about those for a moment because we've had some results now where we can talk about what's happened there. And what the rural opportunity zones were, we had 40 counties over the last decade that had double-digit population decline, mainly out in western Kansas, northwest, southwest Kansas, out in that area. And they'd had double-digit population decline. Obviously, we wanted to see if there was anything we could do to maybe try to reverse that trend where there might be more population increases in those rural areas. We introduced a bill, and our premise was to come up with tax policy would help, along with other things, to attract people to those rural opportunity zones. Started with 40 counties. The legislature, in its wisdom, put another 10 on that, so we ended up with 50 counties as rural opportunity zones in Kansas. And what that meant was if you were moving from out of state into Kansas and into one of those counties, we would give you 5 years no personal income tax for moving back to Kansas and moving to a rural county. We won't know the results of that until we really look at our tax returns this year and see how many people have taken advantage of that. They were supposed to show a tax return from the state they came from, so we'd know they were new to Kansas, and then we would set it up so they'd have the 5 years. So we'll get to know that after April 15th and later this year on how many people took advantage of that part of it. The other part of the rural opportunity zones was a partnership with counties, and the county had to partner with us on this to help cover the costs. But the other part was if you were a student and you were coming from out of state into Kansas, or if you were a Kansas college student graduating and you came after your graduation to one of the rural opportunity zones in Kansas, we would pay up to $15,000 of your student loan over a 5-year period. In that case, you had to apply with the Department of Commerce, and they would go through the applications to make sure you were a student and graduating and coming back to Kansas, or as a KU student could do this, going to Kansas. It was really interesting because the day we had the hearing, I had the Medical Society on one side, I had the Hospital Association on the other, and the Dental Association behind me. And as the committee started wrapping up its debate, they looked at me and said, "Nick, you gave us one of the best recruiting tools you could have ever given us." In those original 40 counties, there were 44 hospitals who could not find healthcare workers. They were having an extremely hard time recruiting healthcare workers. And the Hospital Association in particular said, this is a great recruitment effort for us. To date, the reason I can say we can give some results on that, the Department of Commerce has received a little over 600 applications from students to take advantage of that program. The most interesting thing to me, there's a couple things that are interesting to me. One is they've come from about 30 different states. So it hasn't just been the states right around us. It hasn't just been our adjacent states. It's been really pretty widespread, probably further than we thought it would be, that students would want to take advantage of that. The other thing that was interesting to me is the degrees that are applying to come back to Kansas, to rural Kansas, to start their careers after college. And those top 3 degrees are healthcare medical degrees, engineering degrees, and law degrees. I thought that was extremely interesting. So you got professional young students graduating from college now saying, we're going to make a commitment to go to rural Kansas and start our careers in rural Kansas. So we've been pleased with that. The other half of that is the Secretary of State just recently did a study over a 10-year period of new business filings in the state of Kansas. And there have been 15,000 new business filings last year. It was the best year in Kansas history in new business filings, according to the Secretary of State. When you look at the map of where those new business filings took place, it's kind of what you would normally think. The big numbers are in Johnson, Sedgwick, Douglas, the bigger counties. But when you look at percentage increase, which means a lot to the rural communities, some of the areas that had the greatest percentage increase in new business filings were in northwest Kansas. And if you really look at the counties, a lot of them are the rural opportunity zone counties. I'm asking some economists to dig into that study a little bit further so that we can really see results that we can really quote and say, yeah, this is now helping new business filings as well as students coming back. There's been some tangible results that seem positive to the rural opportunity zones. The other part of the governor's desire, obviously, was to lower income taxes. Now, you brought Arthur Laffer, and I know my friend Tom is going to talk a lot about Arthur today. Arthur, and Bill may have known Arthur, I don't know, but Arthur was in the Reagan White House as an economic advisor. I think he was the first director of the OMB in Washington, D.C. Arthur's been around. He's an interesting gentleman. He was Margaret Thatcher's economic advisor in England while she was prime minister. And the fun thing to me is Jerry Brown's one of his friends. And he's been an advisor to Jerry Brown. Was Jerry Brown's actual economic advisor during Jerry Brown's presidential race when he ran for president. So he's kind of been bipartisan, kind of been on the whole spectrum, a big flat tax proponent, supporter. And Jerry Brown, in years past, has been a flat tax promoter. We worked with Arthur, but I don't want to limit it to Arthur today. I want to say probably one of the most interesting things, and I spent last week when we had a snow day, I got to call somebody in D.C. and spend some time on the phone with them. I spent some time with a gentleman named William McBride. William McBride is the chief economist at the Tax Foundation in Washington, D.C. We had a really long conversation last Thursday and actually spilled over a little bit into Friday about a paper that William just put out. And what William did was he went and looked at 26 different economist studies from around the world. The name of his paper, and you can get it on the Tax Foundation website, is Evidence of Taxes and Economic Growth. And so he went through these 26 different studies of various economists around the world, various economists in this country, and said, what in the world role does tax policy play in economic growth? Does it play a role? Now, I want to be real clear to say that if the governor were sitting here today, and if we're sitting here today, we're not going to say tax policy is the only thing that brings economic growth. Quality of life is important. There's a lot of things that are important other than tax policy. But a lot of the evidence, including William McBride looking at these 26 studies, now are pointing to tax policy does mean something to economic growth. And as he looked through these 26 studies, there's 4 buckets of tax policy. You have corporate income tax, you have personal income tax, you have sales tax and property tax. Those are the 4 buckets that generally he talks about. His conclusion, after looking at the 26 studies from economists around the world, is the 2 best tax policies to look at for economic growth are your corporate income tax and your personal income tax. And Bill, shut me up if I'm going too long, but I'm really leading up where you want me to go. Corporate and personal income tax are the 2 tax policies that create the most economic growth for states and for a country. So you got to have the proper policy. The lower, the better, the economists say. So now if you take that as true, then you know why the governor is looking at corporate and personal income tax in the state of Kansas. Let me talk about corporate for a moment. We would love to lower the corporate rate. But we have so many incentives and tax credit programs that we got to wind through to do that it's going to take some time for us to do that. On the other hand, 59.3% of our C Corps, our big corporations in the state of Kansas, pay no taxes today because of incentives, tax credit programs, probably over the last 3 years, something to do with their profits. But 59.3% don't pay income tax today in the state of Kansas. You will know last year, getting into the tax policy of the past, last year we wanted to help small business in Kansas. And instead of defining it by number of employees, because it gets complicated to do that, and particularly as the Department of Revenue, it gets complicated to administer it, we chose corporate structure. So we said if you're an S Corp, an LLC, or if you're a sole proprietor, we're going to take you to a 0 non-wage business income tax in the state of Kansas. So if you add the 2 business tax policies together, we got almost 60% of the C Corps paying no income tax. Now you have the small businesses paying no non-wage income tax in the state of Kansas. Now 98% of the businesses in Kansas are 100 employees or less. 98% of our businesses are 100 employees or less. 77% of our businesses are 10 employees or less. Those people have had a tough time with capital flow. They've had a tough time hiring. They've had a tough time buying equipment that they might need. They'd have a tough time going out and getting the loan they need to grow their business. Time and time again, when I'm out talking, I'll have, I don't know how many small businesses come up and say, thank you, thank you, thank you. I finally can hire the person I've been wanting to hire. I can buy the equipment I wanted to buy. I can now get that seed money I need to get my business growth that I need to grow my business. So if you're interested in corporate income tax, creating economic growth, we've done a pretty good job of trying to be competitive. We've done a pretty good job of helping our businesses in the money they need. By the way, that corporate competitiveness in the economic development world has just become unbelievable. It's extraordinary what's going on in that area. And it's funny for me to say that because I helped write a lot of the bills that took us where we're at. But it's really become a competitive business. So we feel, okay, we've addressed corporate, we've helped C Corps with incentives and tax credits, now we're helping small business. So let's go over to the personal income tax side. Why is that so important? Most economists, in fact every economist I've talked to, has said that income tax is the most egregious tax on economic growth because it hits the heart of your hard work. It taxes your productivity. It taxes your investment, your ability to be able to grow your own personal income, plan your future, have the funds that you need in your life to do what you want to do. And almost every economist will tell you that's important to growth. I've had some companies tell me it's important to them because when they move, guess what? Their employees, when they move to a low tax or zero income tax state, their employees get a raise all of a sudden, immediately, because of that move. It taxes productivity and investment. Now, William McBride, the Tax Foundation, has said that sales tax and property tax, we're not discounting, those aren't important pocketbooks issues, but they're not the best growth issues. Corporate and personal income tax is what the economists are now beginning to say, broad-based, are the two strategies you need to look at to grow your economy. So what's the governor doing? Last year we introduced a bill to take the tax rate down. We had three brackets in Kansas, 6.42, 6.25, and 3.5 in the state of Kansas. Our bill would take the income tax to 4.9% and 3%. Sales tax would have gone to 5.7, and I'll get back to that in just a moment. And then you heard what we did with small business. We also expanded the standard deductions for certain people. If you're a single head of household, we expanded your standard deduction from $4,500 to $9,000. Married couples filing jointly, we expanded it from $6,000 to $9,000. Today in Kansas, less than 30% of Kansans itemize. It's about 27% of Kansans even itemize in the state of Kansas. Most people do standard deductions. We think it's even going to be less people itemizing next year as they start doing their tax forms and they've got the expanded standard deduction and the lower rate. That it'll even go down even further. So today you have less than 30%. And that's a very important point as we go forward today in this discussion about how many people itemize. So the bill passed last year. The governor had pay-fors in there, what we called pay-fors. One was removing, it's broadening the tax base. You've heard that phrase 1,000 times on the national level. Broaden the tax base, deductions and credits go away, rates come down, and you broaden your tax base. That was a proposal last year. The legislature passed out a bill that lowered the rates but didn't do any of the broadening. It didn't do any of the pay-fors. So coming back this year, the governor has said time and time again, I am committed to fund core responsibilities of government. And what he has said time and time again is education, public safety, Medicaid, and social services are my core responsibilities of government. I've got to fund those, but I want to continue to lower rates. And so what he's proposed is freezing the 6.3% sales tax that was supposed to go to 5.7 this year. Let's freeze it and then do away with the mortgage deduction and property tax deductions. Again, less than 30% of the people use them, and that's going to go down even further if these rates should pass. What this does is this doesn't lower those rates right away. This year, when you file next year, you'll have the 4.9 and the 3. What this would do in 2014 is take the lower rate down again to 2.5, and then in 2016, take it down again to 1.9, and then the upper rate would go to 3.5 in 2017. So it's a phased-in buy-down of income tax rates and freezing of the sales tax and removing the deductions. Earned income tax credit stays in the governor's plan. 17% earned income tax credit in Kansas. We're one of the highest in the country. We're certainly the highest in the region. Missouri has no EITC. Colorado has no EITC. Nebraska's at 10. Oklahoma's at 5 or 6%. So we got one of the highest EITCs. The governor's proposal leaves that alone. Still 17% to help low-income families. We don't change that. Charitable contribution in the governor's proposal stays the same. You'd still get your charitable contribution deduction on your income tax in Kansas. Now let me talk about the mortgage deduction for a moment and the property tax deduction. What happens, we've run 4 counties, my staff. It takes a while to do this, so we can't get to 105 counties right away on doing this. But we ran 4 counties to find out what the real impact is. And I would plead with everybody that, and Tom's heard me say this, please look at things as packages. Don't silo things. And I'm going to tell you why in a moment. Let's take Johnson County, the closest one we did to you. We did Johnson, Sedgwick, and then we did Allison, Montgomery. So we did 2 big, 2 small counties. Johnson County is an example. When you get to the 3.5 and 1.9, I asked my property valuation division to go into Johnson County, look at the median valuation of a home, a single-family residence in Johnson County, which we did, and then look at the median income of someone in Johnson County who itemizes on their income tax, and tell me what the property tax and mortgage deduction will be worth and what your income tax reduction will be worth. Your 2 property and mortgage tax added together is worth about $407 in that scenario. Your income tax reduction you would get under this plan is $1,157. There's a $750 difference, positive, between what you might lose on your property and on property tax deduction, mortgage deduction, and what you'll get in income tax reduction in Johnson County. That's true for Sedgwick County. It ends up to be $600 and some dollars. You take Ellis and you take Montgomery counties, 2 smaller counties, and it's about $500 and some dollar benefit. So you got to look at it in a package. It's easy to say, well, you're losing $407 worth of deductions, or this is a $407 increase in your taxes. The truth of the matter is, it's outbalanced significantly by the amount of income tax reduction you'll get. Now, one other comment, and then Bill, I will shut up. You told us to talk. If I don't let Tom talk, see, it's nice. It's good. One other comment about some of the social. I want to tell you, I've been here in Lawrence with the governor, walking down Mass Street with him several times. And I've seen him stop and give the homeless people money and spend 20 minutes with them, talking with them, asking them what he can do to help them. I just want to say, from my perspective, we got a governor that is compassionate for the low-income people. I know that's been in dispute. I know that the media many times have not painted him that way, but I've watched him. I've watched him work at different charitable. But let me say something about tax policy and social programs. In Kansas right now, we have about $3.5 billion in safety net programs for low-income families. Now, some of you may or may not think that's enough, but we got $3.5 billion. That's federal and state funding. $3.5 billion goes to safety net programs in the state of Kansas. Right now, we got 300,000 people basically on food stamps, which we're not proud of. We wish it was a lot less than that, but we got 300,000 people on food stamps, about $442 million being spent on those food stamps. We are spending $71 million on child care to help people with child care in the state of Kansas. Now, why do I mention that? Because every economist and every CPA person I've talked to over the last 3 years has said, get your social engineering out of your tax policy, and if it's worthy of funding, fund it. Put it into a program that's targeted, accountable, and transparent. And so in essence, that's part of what we're trying to do here too, is saying, okay, we do want to help people with food. We do want to help people with child care. Let's be sure the program's funded to do that. Now, Tom and I know, I was in the legislature a long time, he was. There's never a year goes by that you won't debate whether you're funding it enough or you're funding it too much or you're funding it properly, or that'll be a debate, and that should be a debate that every year comes around in the legislature. But I'm telling you, almost every economist and CPA says, get it out of your tax policy, get it into a program if it's worthy of funding. So all of that said, the governor's plan is to grow the Kansas economy, to increase the net income of Kansas families, to increase private sector employment, and to grow this economy in Kansas. Therefore, everyone benefits. Hopefully there's jobs for everybody, and we don't have a lot of unemployed people out there. Hopefully we can get some people off those food stamps and off those programs into good jobs in the state of Kansas. So with that, Bill, I might shut up and let Tom do his 30 minutes, and then we'll...
Senator Holland, I know that you oppose these policies. Take as much time as you'd like explaining why.
Very good. Well, I think Bill's can everybody hear me okay? Okay. As I shared with Bill earlier, Nick's a former senator, I am a senator, so we could probably run as long as we want to here and just have a lot of fun doing it. Thank you so much for having us here today. I appreciate the Dole Institute putting this together. I'm so glad that Secretary Jordan agreed to do this forum with me. I have put together my own presentation on the governor's tax policy, and I've already started hitting various locations across the state talking about this, because one of my big concerns about this last year in particular was the fact that I'm not really sure Kansas citizens were engaged, where they really knew what was going on in Topeka. And so I appreciate you all for coming out today. My background, very briefly, this is the 11th year I've been to the legislature. I have been the ranking minority member in tax. I served 2 years, I believe, in the House Tax Committee under Chairman Kenny Wilk, as a matter of fact, and then I've been ranking, this is my 5th year's ranking on Senate tax on the Senate side. My professional background, I run an IT small business firm, and so I am not by any means a tax professional, but the information I'm going to share with you today is additional research I've done on my own volition. Once again, I thank you for being here. Just 3 basic points I want to get out on the table right up front, and then I am going to talk at some length about each of these points as far as why I believe these points, in fact, to be true. Number one, based on my research on looking at the way the last year's tax program, bill was structured, as well as what is being proposed for this year, I basically come to 3 conclusions about Governor Brownback's tax policy and where he's taking this state. Number one, I personally believe that this is a tax plan designed, to benefit primarily Charles and David Koch and the special interests that are promoting these plans, and it will hurt everyday Kansans in the long run. The second point that I'd like to make is that there will be no appreciable economic growth coming out of this plan. We talk about going to a 0 income tax rate. As a matter of fact, Kansas won't be able to do it, and I will elaborate further as far as why we will never get there as a 0 income tax state. The third point I want to make with that is that when you look at the actual size, the income tax cuts that were made and signed into law last year, as well as the cuts that are being proposed and actually got passed out of the Senate Tax Committee just this past week, the size of these cuts cannot sustain Kansas government spending as it sits in the state. So you're going to see a significant shifting of the tax burden and or cutting of state services. You need to keep that in mind. So let me kind of dive into now on my positions on this. When we look at the components of this tax plan, if you were to go out and you were to ask Kansans, okay, what do you think we ought to be doing with tax policy? And believe me, every time I'm out going door to door on the campaign trail, I hear from people all over my district as far as you've got to do something about property taxes. And this just isn't something I hear in my district. I mean, folks, this is statewide. When you ask people what we need about tax in the states, it's the property tax. And I want to point you to basically some research done by the Docking Institute of Public Policy out of Fort Hays State University. They do an annual survey called Kansas Speaks. And for the past 3 years, I'm sure it's even prior to that, you go out to this survey, and when they ask Kansans, and this is demographically sampled, they have the right number of Democrats, Republicans, Independents. When they talk to these people, their number one issue is that they want to see lower property taxes. There's very little appetite for either raising or lowering income tax, maybe a little bit more of appetite to raise sales, but still, when you look at a majority of Kansas people in both the 2010 and the 2012 survey, over 50% said lower my property taxes, and 2011 came in at 45%. And so what do we have a tax plan, being offered by the governor? Okay, instead it's totally supply side driven. This tax policy is supply-side economics in spades. And you have to go no further than to look at who put it together for the state. Dr. Art Laffer. I'm sure you all know who Dr. Art Laffer is, right? The father of supply-side economics. Give me a head up or down. People know what Art Laffer is? Okay, very good. Okay, so when we talk about Dr. Laffer, once again, he is considered the father, quote unquote, of supply-side economics. And what that means, just in a nutshell, basically, is that Dr. Laffer and other supply-siders, they want to remove disincentives for those job creators. And so they're going to fight like heck to be sure that we've got lower to zero income tax rates, we've got lowering or zero capital gains rates. We want to be removing regulations from the marketplace. We don't want to do anything to disincentivize those creators to create those jobs. That's going to grow the economy. That's the way these folks believe it runs. Now, the state of Kansas paid Dr. Laffer $75,000 to work with him and the governor to help put this plan together. I would also add that Dr. Laffer is also on the Board of Scholars of ALEC, which is called the American Legislative Exchange Council. And this is one of those corporate bill mills. They're basically a conservative, libertarian think tank that basically provide model legislation to legislators, and they basically put their viewpoints out there in legislatures all across the country. But my point is that when you look at the aspects of the actual bill that was passed last year and what's being proposed this year, it's all income tax driven. In fact, you look at the key components of it, and why I say this benefits particularly wealthy interests like the Koch brothers. The tax bracket cuts went from 3 brackets to 2. And actually, the upper bracket margins were lowered significantly more than the lower brackets. The upper bracket went from either 6.25 or 4.5 down to 4.9. If you look at the lower bracket, it only went from 3.5 to 3. So once again, supply side theory tells you that these folks are focused on those job creators, i.e. the higher wage earners. They want to bring those top marginal rates down as quick as they can. The other interesting thing about this bill, and you really don't see this, and Secretary Jordan alluded to it earlier, was this whole concept of not taxing what we call non-wage income on pass-through entities. And a pass-through entity is basically just generically speaking, once again, if you have a business where you can file a return without doing a corporate return, that's a pass-through entity, quote unquote. So that's a sub-S, an LLC, a partnership, a sole proprietorship, those types of deals. And when you think about this concept of, the governor talks about, we want to incentivize small business and create all these jobs because small business is the economic engine of, our country and our state. Yes, there are very specific or certain types of small businesses that will generate job growth. But for most small businesses out there, they're not going to do any additional hiring. But my point is that when you think about small businesses and this talk about, well, we'll give these small businesses tax cuts, they'll go out and drive the economy. Under the governor's definition, small is in name only. So for example, you look out across the country, PricewaterhouseCoopers, that is an example of a small business. That if they were doing significant business here, they would benefit tax-wise in this state. Farrell Gas, our neighbors to the east, out of Liberty, Missouri, a $2.4 billion propane distributor. That's another example of a small business that might benefit under the governor's tax plan. McElhaney Company, Tabasco sauce manufacturer, $250 million. Another example of small business. But I come back to some big small businesses right here in the state of Kansas that will benefit. If you look at Koch Industries down in Wichita, Koch Industries is a $100 billion corporate conglomerate, a whole bushel basket full of companies. They have some very huge small businesses down there hanging out in Wichita. The first one is a company obviously you've heard of called Georgia Pacific, paper products manufacturer. When the Koch Industries basically took that thing private in 2004, they had annual revenue sales of $20 billion. There's another Koch pass-through entity down there called Invista. They are the world's largest manufacturer of spandex. Their annual revenues was $6 billion in 2010. So these are examples of the small businesses that are getting breaks, incentivized to grow the economy. And my thrust of that is that, that isn't going to happen. I want to talk a little more about this tax plan. Here's just some quotes. Secretary Jordan talks about the tax foundation. And here's a quote from the tax foundation about Governor Brownback's tax plan. They say, quote, "The Brownback tax plan rewards certain business structures while punishing others. There is no sound economic justification for treating these two types of business activity so dramatically differently." That's the group that he's quoting. Another folks, right here, a professor here at KU, Professor Martin Dickinson, professor of law here. He is a nationally renowned family estate planner. This is what Professor Dickinson said about this plan. He said, quote, beginning in 2013, the Kansas tax system will be among the most regressive in the nation. Okay? So, I mean, this thing has had a real mixed bag of reviews. The Kansas media, this was out of Kansas City Star, their editorial. This is last year when the bill was sitting on the governor's desk, and people weren't able to sign on it. This is what the Star said. They said, quote, Kansans are about to witness the stunning act of a governor knowingly jeopardizing the state's future for the sake of ego and unproven theories. Okay, that's the Star, not some liberal rag, running off at the mouth. Forbes Business Magazine talks about stuff. Forbes Business Magazine said, this is what Forbes said. They said, Kansas slashed the tax rate for the better off and exempted huge chunks of business while increasing the burden of some of the state's poorest residents by eliminating a rebate they now get. Another thing Forbes said, this is Forbes Business Magazine, they said when the food sales tax rebate disappears next year, and so this is going to be when folks are filing their returns in 2014 because these subsidies are gone this year. When the food sales tax rebate disappears next year, Kansas will join Alabama and Mississippi as the only states that levy a tax on food and don't some way compensate lower income residents for the strain on their budgets. So we're definitely shifting the tax burden within the income on folks in this thing. And then you had Moody's, the financial services investment firm. Moody's says, quote, a shrinking public sector poses the biggest hurdle to a more solid recovery. Further, lackluster performance in goods production has kept the state's growth below average. Because folks are looking at the size of this tax cut. And when this tax cut for this last year was signed into law, it's fully annualized, it's north of $800 million. And when you understand that Kansas budget is over $6.1 billion, that $800 billion is a huge chunk of change. It's like 14-15% of the revenue. That's got to be made up somehow, and that is no trivial task that we're facing right in the legislature. I want to move on to the second point when I talk about there's going to be no appreciable growth generated from this tax plan. And I want to go back to, as Secretary Jordan rightly pointed out, I heard about this 2 years ago when I was on the campaign trail to get my butt kicked by the governor then. But Sam was out there talking about, you remember the phrase he said, we've got to look more like Texas and a lot less like California. Remember that phrase? We've got to look more like Texas. That was the mantra. Well, this is where his talking points came out of. This is Art Laffer's book, Eureka, How to Fix California. And so that's the reference to California. And there's also data here about Texas. I want to drill into this now. When Nick and the administration, when they came out at the beginning of last year before our committee, and they presented, the plan, they had 5 guiding principles of reform. And the 5th one, and most of the guiding principles, I think, are spot on. I totally, commend them for coming up with that. But the 5th one, the last one, developed specifically by Laffer, with Laffer Associates, says, states with personal zero income tax significantly outperform states with the highest personal income tax rates. This is in, quote, in terms of gross state product. They experience large and average population growth, and they boost state tax revenues at a faster pace than high state taxes. Okay? So what Dr. Laffer is proposing, once again, because he's a supply sider, so his whole thing is gee, Kansas, you guys can be just like all these 9 no-income tax states by taking your income tax rate to 0. And he comes up with this data, and it's summarized, and Secretary handed this out to all of us in the legislature last year. They show these 9 no-income tax states, and they say your gross state personal product growth over the last decade, this was from 2001 to 2010, your gross state product growth was 58%. And we look at the U.S. average, it's only 46%. And by golly, when you look at those 9 states with the highest personal income taxes, their gross state product growth was only 42%. So it's anywhere from, like, say, a 12 to 16-point swing, all right? And when you look at that numbers initially, you think, boy, that is neat stuff. That's really impressive. But it's like anything else, you got to start peeling layers off the onion and look down below the hood and really see what's in the engine. And then you kind of understand what you're dealing with. First of all, you have to ask yourself, when the governor says we need to be more like Texas or Florida, so what are these no-income tax states? And realistically, could we be like them? So let's talk about some of these states. The 9 no-income tax states we have, okay, in the union are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. And so when I went and I got Dr. Laffer's book, I said, I got to learn more about this stuff. And so I started drilling down and looking at the actual performance figures by state. And you would think that if you're going to make the case about, hey, you got to be like these 9 no-income tax states, you would think their performance data would hang relatively close together. I mean, you'd think they'd all be really tight, they all be uniformly performing above the rest of the other states who have an income tax. Well, they don't. And what Art does is basically, I mean, this really is junk economics, because what he has done is he takes outlier data and he does these simple averages to show, hey, as a whole, the group did so much better. But when you start looking at individual state performance, you quickly realize that those states have just gone bananas from an economic growth standpoint, that they had some very peculiar things happening to them in the last decade that allows them to take advantage of that, and it really skews the results. So let's talk about some of these no-income tax states and see if Kansas sounds like them. Let's start with the state of Alaska. Alaska is the second least populated state in the union. What does Alaska do? Oil, right? Okay. When you look at Alaska's severance taxes, okay, they lead the nation in severance and royalty taxes at 53% of their state general fund. All right, just because they're producing so much oil. The other thing that really drove their gross state product number was domestic crude oil prices shot up 210% during 2001-2010. If you know anything about gross product calculations, it's the value of the goods and services sold during the period. So anytime you have just energy prices rising, your actual production levels may not have changed at all, but because the prices are going up, you're going to see tremendous shifts upward in gross product. And that's what we see with Alaska at 77%. That was the second highest. Now the number 1 highest growth was Wyoming at over 100% increase in GSP. What does Wyoming do? They're the country's largest producer of coal. What did coal prices do during the last decade? They went up 124%. Once again, they're mineral driven, and because of those rising prices in energy, they saw some phenomenal growth that Kansas is never going to see. And it's a false analogy. The governor, let's move on and look at some other states. The governor loves to talk about the Texas miracle. And hey, Texas has done some great things. Don't want to take any away from that state from an economic development standpoint. But once again, Texas has some things going forward that we don't have in the state of Kansas. Number 1, once again, you go back to the oil and gas industry. That is so big down there in Texas. It's like $325 billion directly and indirectly goes to the state in activity. And their total tax revenues from oil and gas industry itself is 20% of their budget. We're never going to see that in Kansas. Okay, when you look at Kansas, our current oil and gas severance is a little over $100 million. Once again, a $6 billion budget. That's not even 2.5%. We're not going to get there, folks. So once again, it's an apples to orange comparison. The other thing Texas has going for it, which is really interesting, is that they have a huge tourism economy. You know anything about Texas? They got about 400 miles of coastline down there. And they have all those inlets. They have over 3,300 miles of sandy inlet beaches. So they've got a huge tourism economy, about $57 billion. Kansas doesn't have anything like that. The other thing they have down in Texas, they have lots of federal spending. They have both significant military and civilian agencies that do work down there. A big part of Texas' economy is export shipping. There's 14 cities on the Gulf Coast in Texas. Houston is our largest North American exporter city down there. And so that's a huge deal for them too. And also, keep in mind, Texas, like Florida, they're turning into a retirement destination. So we're seeing people go down there, and that's helping grow their population numbers. The other thing that helps their GSP that we don't have is that Texas has a 38% Hispanic population with very strong birth rates. And so through a lot of new births down there as well too, that's helped growing the economy. I'll wrap with one more thing, but I want to talk about Florida. The governor has said on record we need to be more like Florida. Well, once again, let's get real. I mean, Florida had 82 million visitors visit that state in 2011. They had a $70 billion annual tourism economy. How Florida survives without income taxes, basically they're taxing both the out-of-state property owners, because we all know lots of out-of-state owners own property in Florida. And they're also taxing those visitors with the sales tax. So that's how they get by without having an income tax. Over 85% of their state and local taxes come from sales and property tax. So my point is that when you take Laffer's data and you start looking at the 9 states, 5 of those we'll never compare to because we don't have the mineral wealth, we don't have the tourism. So when you really cut to the chase and you look at the 4 remaining states I think we more realistically line up with, their actual growth is below the national average, not surprising. Their state and local tax revenue growth is significantly below the national average. So what I would just propose that when the governor says we need to we need to be like Texas, he's providing a false analogy. And I'll just put it as this example. I'm 51 years old. Saturday mornings I run off and I go play basketball with a group of guys my age and skill. Okay. Now the governor could look at me and say, Tom, you could jam just like Kobe Bryant by putting on a pair of Nike, Dream Season 4 Nike Kobe shoes. And I could strap those shoes on, I could run up and down the court, and I'm still not going to touch the net, let alone jam the basketball. And my point bringing this up is that, not surprisingly, Kobe Bryant has some inherent physical characteristics that allow him to be a heck of a basketball player, which I will never be. And so just this talk about we be more like Texas by the zero income, it's a false analogy. I just reject that. I also want to point out, too, this whole discussion about Kansas going to zero income tax, folks, this is happening all over the country. Okay, you've got our neighbors to the east here, you got Missouri, they have their own billionaire over out of St. Louis called Rex Sinkfield, and he's an incredible rags to riches story. He made his wealth in the financial services industry, but he's been driving their legislature to do the same thing over there. And they have a nonprofit economic group over there called the Missouri Budget Project. And they did a study to see, okay, let's look at all the states and try to find this correlation between lowering your income tax and creating economic growth. And what the Missouri Budget Project said in their result, they said, hey, the data clearly indicates that there is no consistent or systematic correlation between a state's utilization of a state individual income tax and its rate of economic growth. I also want to point out there's been a national study, and Secretary and I talked about this a little bit before, but the Congressional Research Service, these guys and gals are the analytical arm of the U.S. Congress. They originally published these results in September. They pulled them back and they republished them back in December last year, and they haven't walked away from them yet. But they say about this whole thing they have this report called Taxes in the Economy and Economic Analysis of the Top Tax Rates since 1945. And what the Congressional Research Service says, they said this analysis finds no conclusive evidence to substantiate a clear relationship between the 65-year reduction in the top statutory tax rates and economic growth. They go on to say, rather interestingly, the top tax rate reductions appear to be associated with the increasing concentration of income at the top of the income distribution. So what the CRS is saying is you're getting basically a wealth gap, okay, when you look at these policies that drive down income tax rates. I would finally say that the governor and administration talk about creating jobs with this. Keep in mind, most of these 9 states that have a no income tax, they typically have a 4th revenue stream that we don't have. That I alluded to, it's either tourism, minerals, gaming like Nevada. But the administration themselves, last year they came out and said, with this tax plan, we're going to create 23,000 new jobs through 2020. And it's like, that's it? Because when you look at really the new job growth we actually had in 2012, this past year, the state created 4,900 new private sector jobs without any sort of, tax juice from this income tax cut. So this will not create jobs, and this is not going to take us to a zero income tax because we don't have the other revenue sources to support that thing. Now the final comment I want to make is that this whole notion about, and folks, these tax cuts, they are unsustainable for our current level of government spending. And what I want to just briefly share just some data from Legislative Research Department. The bill that got passed last year, as I said earlier, when you fully annualize the cost of that income tax cut, for fiscal year 2014, it was like $802 million. Once again, out of a $6.1 billion annual budget, that is significant. And you look at, say out of like the next 6 years, say for the fiscal year 2018, the cost of that tax package that got put into law last year is $4.5 billion, that's with a B, billion dollars. All right, $1 billion. So that is a huge hole that we have got to fill. Now, we're not like Washington DC, we've got to have a balanced budget going forward. So it means significant cuts and or tax increases to plug that hole. And not surprisingly, guess what the governor proposed this year? He calls them pay-fors. They're really tax increases, okay? But he's proposing tax increases to plug that hole from last year's tax bill. And so to talk about that a little bit, as Nick talked about, basically what are the things he's proposing? He wants to extend that sales tax increase at 6.3%. I voted for that back in 2010, but I also voted to make that temporary, and it was supposed to fall back to 5.7. He's trying to raise that to 6.3 again. As Secretary indicated, he wants to eliminate the mortgage interest deduction, and he also wants to cut income tax rates even further. Now, here's the dilemma the governor's got himself in. Because when you look at the cost of last year's tax cut and what it does to the budget, when you look at not this ending fiscal year 13, but when you look at just 1 year beyond, if you don't do anything to change spending, if you don't do anything to change the revenue mix of revenues coming in, we're turning $61 million in the hole. Now, that's maintainable, okay? I mean, we can address that. But as you start looking out in the out years, here's where the problem with this tax cuts come into effect. Because they're so big and they keep growing through the loss of revenue, end of 2018, our fiscal year deficit is $2.5 billion. So he's got to try to find a way to once again plug that hole. So he introduced this year Senate Bill 78, which was his pay-fors, i.e. tax increases. And as I said, he wants to keep the sales tax rate at 6.3, eliminate the mortgage interest deduction, and increase these income tax rates. But the dilemma he's got himself in is he's got to get politicians to vote for this bill. And his problem is the moderates like myself who voted for the temporary sales tax increase in 2010 certainly aren't going to vote to extend that sales tax increase because we voted and made a promise. The other problem he's got all the new conservatives he's got in the legislature. The last thing they want to do is vote for any tax increase, right? I mean, they signed the pledge to Grover Norquist and all that stuff. So what he's done is he's had to put a carrot with the stick. And so what he has proposed in this pay-for bill, once again, we've got the upfront tax increases, but we also have the farther out tax cuts. This is the additional lowering of the income tax rates. And Secretary Jordan, I'm going to be talking about this in a minute, but basically he wants to take the lower rate from 3% down to 2.5% and then 1.9% in fiscal year 14 and 15, and then he wants to take that higher rate of the 4.9 down to, I believe it's 3.5% in fiscal year 2017. So what this bill does is it plugs the fiscal holes up front. So in 14 and 15, we look at the ending balance for our budget, we're okay. But the issue is you start getting out to fiscal year 17 and 18 again, okay, we fall off the table revenue-wise. So for example, when you talk fiscal year 2017, 4 years out on budget planning, we're turning $15 million underwater, and then into fiscal year 18, we're nearly $660 million underwater. So that is the dilemma that we are facing in the legislature right now, and that is why I contend that we can't afford these types of tax cuts. So anyway, I appreciate your indulgence with that, but that's my take on things.
Thanks, Senator. Let's talk about a few specific issues a little bit more briefly before we open it up to questions from the audience. First of all, let's talk about, I asked the speakers to take as much time as they wanted to make the case. I think it's very important that they be able to make the detailed cases, very rational intellectual cases on both sides, so I asked them to do that. So, but let's talk about a few key issues. A lot of people, Mr. Secretary, say this plan is regressive. Is it a regressive tax plan?
Well, actually, if I can maybe comment on a couple things Tom said too.
Go for it.
One is, talking about property taxes, we all hate property taxes. I would say if you make a poll anybody, we'd all say lower property taxes. I'd like to see Tom's plan to lower property taxes. The reason I say that is the state has very little to do with property tax. The only property tax we level is 20 mills through K through 12 education and 1.5 mills for public buildings. Everything else on property tax is leveled by local government. So if you want to lower property taxes, you're going to have to cap your local government, or you're going to have to tell your local government they have to lower their property taxes, therefore interfering with one of their basic revenue streams in the local community. So the reason we don't have a property tax plan here is we're trying not to affect local government and their ability to provide the services they want to provide on the local level. So I wanted to get that out of the way, number one. Number two, on the fiscal notes that Tom talked about, this actually is a $392.4 million tax reduction in 2014. And it ramps up to a $1.473 billion tax cut in the last year. The problem with some of the figures in 2018, 2017 that Tom is mentioning is they're based on a static growth factor of 4%. Between 2011 and 2012, in the state of Kansas, the fiscal year 2011 and 2012, our tax receipts grew by 8.2%. On these static projections, they're using 4% growth. In 2012 to 2013, the first 6 months through December 31st, we were growing by 6.2%. So in the most previous last 2 years, we're experiencing more growth than the static projections show that are being used in the out years. I was quoted in a Wall Street Journal article, and by the way, I didn't bring my bibliography with me today. We can all play tennis together on pros and cons, who wrote the positive and who wrote the negative. There's been plenty of positive, there's been plenty of questions. But the other thing I want to quote, I want to talk about a couple things. This migration, in-migration, these other states. Let me tell you what's happened between California and Texas. Texas last year being the #1 state that Californians moved to. Now, Californians aren't moving for mountains, they aren't moving for tourism, they aren't moving for beaches to Texas. It ain't happening that way. Something's happening that's making Californians leave California and go to Texas. Jobs probably are one of them. And guess what? Texas is 0 on income tax. Listen to these statistics. Between 2000 and 2010, over 225,000 Californians moved to Texas. It represented over $4 billion worth of income, left California and went to Texas. It, again, wasn't for beaches. It wasn't for mountains. It had to have something to do with jobs and maybe tax policy when you got a 10% income tax. Last year, again, Texas was the #1 state. Just take 1 year. Texas was the #1 state that Californians moved to. About 15,000 Californians moved to Texas just between 9 and 10. And they represent about $379 million worth of income, left California to go to Texas. One state that Tom didn't talk much about is South Dakota. And he's going off Laffer statistics. Let me tell you about the most current South Dakota statistics that come out of the census. Latest census numbers for South Dakota. Now, you all tell me people are going to South Dakota for the weather. Or they're going to South Dakota for tourism. I don't know how many times you can go to Mount Rushmore. They don't have it. North Dakota's oil. South Dakota's oil revenues are about 0.2%. It's North Dakota that's getting the oil. Well, and so why did they go to South Dakota to live instead of North Dakota? South Dakota, 0 taxes. Here's what's happened in South Dakota. Latest census numbers. The Midwest region, Census Bureau blocks the United States down into 4 regions. Midwest region's one of them. South Dakota's in it with us. The Midwest region as a whole had a 3.9% growth in population average. You know what South Dakota's percentage of growth was in the latest census numbers? 7.9%. Far outdoing any part of the Midwest. South Dakota. Sioux Falls, South Dakota, over the last decade, 67% increase in job growth. Sioux Falls, 67% growth in jobs. Bureau of Economic Analysis between 2010 and 2011. South Dakota led the nation in income growth. Total income, South Dakotians grew by 12.8%, in per capita by 11.8%. Led the country in income growth. So compare us to South Dakota. Don't compare us to Texas. Don't compare us to Alaska. If I could only get 1/4 of what they're doing, I'd be happy. But we've got to stop a declining economy in the state of Kansas. And people like South Dakota are seeing growth at 0, both corporate and personal income. I'll compare to South Dakota any day. And I would think some people might want to move to South Dakota to Kansas except for these last 2 weeks. I remember my mom and dad talking about snow above their door there. Let me talk about the tax policy for a moment and its regressiveness. ITEP, which I'm sure Tom's about ready to talk about, the Institute for Tax and Economic Policy, has come out with a study on last year's policy, but they've also now looked at what happens under the governor's new proposal of going to 3.5 and 1.9. We are a progressive income tax under both proposals, according to ITEP, who've been one of our critics. And guess what? Every income bracket under the governor's plan gets reduced taxes. ITEP reports that. Everybody does. Now, if you add in sales tax, the lowest income, average $12,000 income, loses $22 according to ITEP. Everybody else, when you put income and sales tax together, has reduced taxes under the governor's plan. So again, look at things in a package. Look at things in a package. ITEP, if you read the report, will tell you every state in the union is regressive because they have a sales tax. The ones that have it have a sales tax, are regressive. Of course they are. We understand that food on low-income people is regressive when they have to pay sales tax. We understand that. But looking at economic growth, there's one tax you decide how much you're going to pay. That's called a sales tax. You decide. You got to buy food, I understand, but you decide what you're going to pay in tax when you go out to buy something. You decide whether you're going to buy the big item, the small item, or what you're going to buy. It just doesn't, according to economists again, and by the way, the Tax Foundation took the Congressional Research Study, just recently came out and gave it an F. Said it really didn't change much from the one that they had to withdraw previously, and went and criticized them. Again, you can go to the Tax Foundation website and look at it. They just graded it as an F. That it didn't really, because it didn't take into account variables. It was timed wrong. You don't look at the 1 year after you do your tax policy and say it worked or didn't work. It takes a while for tax policy to work. And the Tax Foundation called it an F. So with that, Bill, I don't know if I answered your question.
Okay, Senator, would you like to respond to that and also respond to the question, is this regressive?
Sure. Well, basically, to follow up with Secretary Durham's comments about property tax, last year I actually introduced legislation into the Senate that would basically provide property tax relief to local units of government through an ad valorem mechanism. And so it can be done. It can be done rather straightforward. I guess a couple things I want to point out. You know, once again, I'm not saying necessarily that, you know, this information should be totally discounted, but my point is that, you know, when people bring forward information like this, like Dr. Laffer, our legislature, and make this case and really talk about how we need to be emulating states that we really have nothing in common with, it just doesn't hold water. And, you know, and while, you know, Secretary Durham might point out, you know, South Dakota, you know, I can point out other no-income tax states like, New Hampshire, it had a 35.2% gross state product growth rate, and others, they're just in the toilet. I mean, the point is that this stuff does not hold up, and to, you know, base, you know, supply side to drive this, I think is inappropriate. I do want to talk about regressive nature, though, of the tax policy, because there are some regressive things in the governor's tax plan last year. I mean, when we talk about eliminating, for example, the food sales tax rebate, I mean, you're talking about 380,000 Kansans, okay, that rely on that. I mean, that is a significant chunk of change. When that's $58 million, but I want to say that's somewhere around, what is that, Nick, about 150 bucks? I mean,
145.
I mean, you know, that is a family, folks, that when they do their taxes next year, because they got pulled away from this year, you know, that's a credit. That's going to be gone from them. We've got another set of folks out there, basically that lost. These would be on renters that lost the property tax rebate. This is about, what, $13 million program, but basically this means about $300 a piece for 44,000 folks. That's gone as a credit next year. So when you look at the overall regressiveness of this, I mean, yes, just by its very nature, when you get away from an income tax, I mean, the income tax is the only really progressive taxing structure any organization has. I mean, just in general, when you talk about it. So it's not to pick on this guy unnecessarily about his being particularly regressive, but my fear is once again, because of the significant holes in revenue, because of the size of these income tax cuts, you're going to have to be, the legislature is going to be coming back and having to make more and more income tax increases. And my fear is that you will see additional regressive things put in the code for that. And you'll see our citizens who are less off get hurt as a result.
Now, I've seen, okay, go ahead.
Just 2 points on this. One is, Tom mentioned the bill he put in last year, and what that is a transfer to local government called the LABTR. It's supposed to help with property taxes. I actually asked my staff to go back and look at the years that LATVR was in place and it was funded. There is no noticeable result in reducing any mill levies or valuations in the state of Kansas. Had no impact whatsoever on helping you with your property tax. So while it's a good thing and it should be used that way, what happens lots of times is counties and cities go ahead and do what they want to do in taxes and take the money for their budget. I'm not going to accuse all counties or cities of doing that, but we see no evidence that mill levies or property taxes were affected through that LABTR. On the regressive side, what's forgotten again, remember we doubled the standard deduction for the single family, single parent household. They've lost $145, but now they got a $9,000 standard deduction on their income tax. You got to again look at this whole package when you look at it. You got to remember, some of them are getting their food stamps. Again, we'd rather they didn't. We'd rather they had a job and didn't have to go on food stamps. But they pay no sales tax on food today through their food stamps. 300,000 Kansans, $442 million worth of paying out there. Again, great, we want to help low-income people. Economists, CPAs have told us time and time again, get it out of your tax policy, get it into programs, fund them, and take care of them. And I think that's probably a good policy to follow.
What about the revenue shortfalls that have been discussed? I've seen estimates of 200 million this year, maybe as much as 800 million shortfall next year.
The governor's proposal this year, and Tom alluded to it, on 14 and 15, which is the budgets they're looking at, the governor proposed 2-year budget this year, both have the statutory 7.5% ending balance in them. So there's not a shortfall in those 2 years. Again, my comment earlier, when you get past those 2 years and go out, you've got a static projection, which we're already beating in a lot of our revenue streams of 4% going out. So to me, I think you could look at a 5%. If you just look at a 5% growth rather than 4% growth, it makes a huge difference in those bottom line numbers. So out years are guesses. These 2 years, we can get a pretty good idea, and particularly the governor's budget. In there, he funds K through 12 pretty level this year, puts a little additional money in. I think the Board of Regents complimented him for funding higher education in his budget for the next 2 years. Medicaid, you're going to have to get the lieutenant governor in to talk about that, but he's got plans on helping let Medicaid. But the bottom line is we hit the statutory 7.5% ending balance with the governor's proposal and a net tax reduction.
What's your response to that, Senator?
Well, once again, he needs the tax increases to hit the ending balance at the end of 2014. He's got to have that to make that happen. The other comments I want to go back to and make is that, number one, the Tax Foundation, they do receive financial support from the Koch brothers. I want to get that totally out on the table, so I would not call them exactly neutral in this discussion. The other thing I want to talk about is we talk about these growth estimates. When you go back and look at the actual economic growth of the state, so the past 20, 30 years, and not discounting things the Secretary said, in the near term, once again, we've been in the Great Recession, right? So, I mean, we've seen growth coming out of these last couple of years. Yeah, the economy's starting to take off, but over a long term, when you talk about a 4% growth rate that's figured into these state general budget runs, okay, when you talked about ending balance, I mean, that is probably on the positive side. It's actually something less than 4% when you look out over the past, say, 20, 30-year horizon. So I guess my point is that, yeah, there's some near-term positive things going on, but I mean, as dynamic and unstable as the economy is, I mean, I don't think we can bank on those things going on in the future.
Okay, I'm going to open it up to your questions and answers. In just a moment, I'm going to give my students with the mics a couple chances couple moments to get out and get ready. I didn't give them a heads up as early as I normally do. But I want to remind everybody that we place a real premium at the Dole Institute on being civil and courteous, and please do not get up and make a speech. Please ask a brief question. Okay, let's go. We've got somebody back there.
You both for being here today. I've really learned a lot about taxes. This question is for the Secretary. You seem to be fond of Governor Brownback, and you mentioned kind of in passing how Brownback used to walk down Massachusetts Street and he would speak to homeless people and give them money. That just seems kind of preposterous to me, but I'm assuming it's true. Could you give us more insight into Brownback and his compassion to the poor?
I'd be happy to. I didn't really want to get off on that, but I know as a cabinet, we go as a team. In fact, in November, we were over here working with your Salvation Army, putting together meals and helping serve homeless people in November. That is probably a regular, at one charity or another, a regular activity the governor is involved in. I can just tell you, I just know that that's when we have a cabinet retreat or we get together in a cabinet for any special occasion, it's generally to help a charity somewhere and help someone on the low-income side or some kind of service organization that helps low-income folks. We do a lot of work in the agencies for United Way and for Project Topeka in Topeka, and then a lot of other charities. So I don't know how to answer that question except to say that it's a pretty regular practice of this administration to be helping somewhere and serving somewhere to low-income homeless people in the state of Kansas.
Okay, we have a question right here.
Hi, appreciate both of you being here, and Secretary Jordan, I appreciate you explaining the long-term plan of this taxes, because I think what the newspapers have hit have been very small particulars or the taxes in 1 year and not really talking about your long-term multi-year plan. So I appreciate your broader explanation. Now I live here in Lawrence. My husband was a college professor, but we have a farm out in far western Kansas. So I also appreciate the Brownback administration's view of Kansas as the entire state, that it does not end at Salina. Like sometimes the journal World seems to think. So it really does make a difference to look at the whole state and bring in some of these rural development situations to help the entire state grow, because without people, there's no economic growth. My concern, however, is when you start talking about cutting taxes, how we're going to fund some of the basics that you've talked about, in particular education, because I'm hearing things that Johnson County and other counties, because they're bigger tax base, will under this plan be able to have more funds for education than, say, the Scott cities of far western Kansas, and without an excellent education system throughout the state, that's your ground, that's your basis for any kind of development. So I'm wondering how you're going to continue to support particularly education across the state.
This plan doesn't really address the education's in a formula. Basic education finance for K through 12 is in a formula. And if I could just personally do an essay here for a moment, I think the formula needs to be changed. In reality, this plan would not affect Johnson County one way or another on education funding, I don't think. But the formula does. And I'm a former Johnson County senator. For years, I kind of fought that formula because Johnson County's always been in the lowest 10% per pupil expenditure in K through 12 education, believe it or not. And every time we put more money in, they stayed in the bottom 10% of per pupil funding. To me, it's more of a matter of the formula than it is the amount that's available. Again, we can argue whether you're putting enough into education or not. But for years, I kind of took some arrows, to be honest with you, because I thought until you change the formula, some parts of the state probably won't see the proper funding that they need to educate folks the way they should be able to educate them. I'm a big local control person, and I would love to see more local control. I understand that a mill in Johnson County raises a whole lot more than a mill does in Scott City, and so the formula is trying to balance that out. But there's got to be a better way to do it than the formula we currently have today, in my opinion, in my personal opinion.
Senator, do you want to offer anything?
I'd love to. Thank you for your question. I mean, it's very topical. I mean, I think just a few weeks ago we had the district court judges rule that basically the legislature's not fulfilling its constitutional duty. I mean, folks, keep in mind what's going on here. If you'll recall, we had a special legislative session in 2005 where your legislature tried to basically push back into those so-called activist judges that had the tenacity to tell the legislature what to fund schools at. And in 2006, the legislature came around and said, okay, we're going to fund schools to the tune of a 3-year plan, $466 million increase. What happened? We started funding that plan, the legislature meeting its constitutional obligation. Along came the Great Recession. And so when we saw our revenues dry up, and we had an unprecedented, like 3 years back-to-back revenue shortfalls, actually falling of revenues, we had to pull away from that plan. But my real concern with what has happened now under the Brownback administration is that, as the Secretary alluded to, that growth is coming back now. And instead of taking those monies and putting those back into the K-12 plan, like the legislature promised the Supreme Court in 2006 that we did, we don't do that. We turn around and we make this massive income tax cut. And we're going to get in a pickle if the Supreme Court says, you folks need to fund schools to the tune of what you said you were back in 2006. That's at a minimum another, I want to say, $500 to $600 million we're going to have to come up with. And that certainly will not be easy. So once again, we need to keep in mind all of our obligations as we go forward. Schools is a very important one. Kind of elaborate once again, there are huge disparities in wealth in this state. Once again, as the Secretary alluded to, you go out to Blue Valley School District out there, you raise a mill out there, that probably gets you about $2.5 million of a mill increase. You go down to one of those little school districts in southeast Kansas like Galena, you raise a mill down there, it's like $19,000, $20,000. You are talking huge disparities in education going forward if we break away from the current school finance formula that we have. And I fear that for our kids if we do that.
Okay, next question, back here.
Hi, thank you to both of you for being here today. Of course, we know that tax policy can't stand alone. It's part of the governor's larger budget proposals for the state. And one of the governor's hallmark programs is, of course, CanCare, which moves our Medicaid consumers under a managed care model and is estimated to save the state about $1 billion, according to the administration, over, 5 years. I would imagine that those $1 billion cost savings must factor into the governor's overall budget vision for the state. If the state doesn't achieve the cost savings that are projected to be saved under CanCare, would the tax proposals as they're being proposed now still stand, still be as effective?
I suppose they are. You get into the budget, that's a new division. And I'm not really in tune with the details of the CanCare or the budget situation, but I can tell you again, the next 2 years are funded. The governor, I think, Tom calls them tax increases. I think the governor, instead of trying to go to 3.5 and 1.9 tomorrow, has realized that we've got to fund some of the core responsibilities of government. And he's trying to come up with a way to be very, what I would say, somewhat pragmatic. We've got to fund some of these areas. We do have a court case sitting on the table. So let's set ourselves up to continue the income tax reduction, but also take care of the responsibilities the government has for the next 2 years. And so he's tried to do that. I can tell you, Tom has talked about a legislative political scenario that's being faced in Topeka. I can tell you, I would almost, and I don't know whether Tom would agree with me, if I were to poll the legislature today, a majority, at least 21 and 63, which would be the majority of the Senate and the House, want to continue lowering income taxes in the state of Kansas. Most of them want to get to zero. Most of them don't think the governor's getting to zero quick enough. And so the political scenario we're setting in is the governor trying to make sure, as he said, I'm committed to funding core responsibilities of government, and I would like to continue a path of lowering income taxes, and this is the proposal I put before you. Door is open for any other thoughts, plans, anything else the legislator has that might make it work differently. The door is open to listen. So far, my response from being in front of tax committees has been, some people don't want to keep the sales tax at 6.3. Some people are wondering about the mortgage property tax deduction. We're working through the same things you've heard today with a lot of legislators. But their next comment is, we're not going to zero fast enough. And so you go, okay, what's the plan then? How do we help you get to where you want to go? And there's not a great answer from most of them, to be very honest with you. We all have the same goal. We all like to get to the same place. It's just now walking through getting there. So the governor, again, has proposed a plan that funds core responsibilities of government, but continues the path that he said since the day he was on the campaign trail. I want to go down this path. He has not varied from that path whatsoever.
A response, specifically to your question, yes. In the SGF budget runs that I've done the analysis, that is the assumption that those billion-dollar savings will be realized. If they are not, the hole is deeper. I want to go back to one of the tax increases the governor's talking about as far as he wants to get rid of the mortgage deduction. I guess I'm less concerned about this discussion. Is that particularly a regressive, increase or whatever? My concern with getting rid of that deduction in particular is, number one, I'm very concerned about our economy from the perspective. You talk to builders out there, and our economy is very fragile, particularly when it comes to new home starts and things like that. My concern is that if we get rid of that mortgage deduction, the adverse consequences that might have on people, wanting to build a new home or even just buy a home. And I think we need to look at that very carefully before we look at that specific elimination of that deduction.
A little fun side to that Kansas City Star, that's not a liberal rag or anything that you mentioned a little while ago, has written 2 editorials saying get rid of the mortgage interest deduction and property tax deduction.
Okay, very good.
Okay.
Do we have a question?
Back here.
Back here? Okay, good.
This is for Secretary Jordan. Being a college student myself, I was just wondering how the new tax policy will affect college students.
Well, obviously, your income tax will be lower. And if you want to go to one of the rural opportunity zones, rural counties, you'll end up getting part of your student loan paid for, and maybe 5 years of no personal income tax. I think there's a lot of benefits in this for a college student. I think from the budget standpoint, the universities, again, I see folks here from KU. The regions complimented the governor for keeping the funding as well as he did in his budget proposals. So from the higher education standpoint, I think they're pleased with the situation we're in. By the way, probably for the same reasons the regents made that comment, the Kansas Association of School Boards came in as proponents of this tax plan in the legislature. So they were supporters of the tax plan also. So just an FYI.
Senator?
I have a slightly different answer for you. I think possibly your tuition rates are going to go up. When I say that, because while there is this, I would agree there are some politicians, maybe particularly in the Senate side, that want to go to this zero. I can tell you there's a lot of folks in the House side. In fact, Speaker Merrick has talked about this. He's not sure he's got the votes for the sales tax increase. And why I do applaud the governor for his recommendations for some of the new building starts, like the new health center over at UMKC, and repairs.
It's KU, not UMKC.
I'm sorry,
we won't fund
KU.
UMKC.
And the architecture building renovations over at K-State. The problem you're going to have with those types of proposals, however, is the fact that you've got a number of conservatives saying we need to be cutting our budget and not spending on these other things. So back to your thing, I think you might very well see that as far as the end run, less result for our universities and you having to pay higher tuition rates.
Okay, we have a question back here.
This is a question for the senator. When you were examining the different states that didn't have non-income taxes, you made a point to say that among those comparable to Kansas, all of them fell below the national average for growth. Do you really think this is a fair measure to use, considering that the national average for growth is going to be skewed upward by the same outliers that you excluded, like Wyoming and Alaska?
I'm sorry, I'm not quite sure I understand. Can you try me one more time with that, please?
Just that you use the national average for growth as a benchmark to for among the states comparable to Kansas, and said that none of them exceeded that. Wouldn't this national average be pulled upward by states like Wyoming and Alaska that you said were outliers?
Yeah, they would. As a matter of fact, they are. So if you actually would reduce that national average by what I would turn those outliers, it'd be even lower. So that is correct.
Okay. Question here.
Thank you both you guys coming today. Glad to see you both. Don't see you very often anymore. The question I have is, Nick, I think you mentioned that the state generated in 2012 15,000 new private sector jobs. But I also have heard, and I'm asking a question, is Wichita State down there had done a study that it was going to be, over 25,000 for this year alone? And I'd be interested to know.
Yeah, the 15,000 I quoted are not new jobs. Those are new business filings. So those are new business startups in Kansas, 15,000.
Isn't that also
So KU, or Wichita State, no, they're two different deals. Wichita State did say 25,000, and the number that Tom gave earlier on the growth that we gave out of what we thought might happen last year is on top of normal growth.
Okay.
So it's just those two little definitions or clarifications.
I do want to point out, though, when we talk about these new job starts, keep in mind, because of the fundamental nature of this exempting, the taxation of the pass-through wage, you're seeing a lot of folks out there setting up these pass-through entities purely for tax avoidance purposes. And full disclosure, I'm one of them. I'm one of the, I run a small C-Corp business, and we basically flow our income straight through our corporation. Well, I'm sure there's other business people just like myself who will benefit by setting up, LLC, a sub S, and basically riding that through them and then taking that back onto their individual return. So when you talk about all these new business starts, you're not going to see one single job created. This is tax avoidance activity at work.
And I don't believe what he just said. I think there will be job creation. And number two, please, before you change your corporate structure, check with a CPA or financial advisor, because your federal tax liability could change dramatically if you just change to try to take care of Kansas. You've got to make sure. I'm sure Tom did that. But I got to tell you, when we thought of this idea, when we thought about putting it on the table, every CPA said there are not going to be very many changes because the federal tax liability will become really burdensome and troublesome to a company just to change to try to get a benefit in Kansas.
Okay, we're going to take two more questions. So we have one back here.
My name's Dennis Sweeney, and this is a question for the Secretary.
How come I'm getting all the questions?
Well, better look. Good question.
No, that's good.
Maybe we can do a study on that. My question for you is, I try to understand the side of the very conservative Republicans here in Kansas. And I'm a small business owner in Johnson County. And the first thing that bothers me or concerns me is this general disdain for government or real mistrust of government that I think is discouraging and not very helpful. So I asked this question because I really want to understand the thinking. Now, as a small business owner who is organized in a C corporation, I will get a 6% discount on the pass-through of my income. So this year I'll probably save $6,000 to $7,000. The thinking, from what I can gather, is you guys believe that then will entice me or motivate me to go hire a new employee with that 6%. So I'm just trying to understand your guys' perspective on that. Thank you.
Well, you're different than a lot of people I've talked to. I have talked to some folks, and maybe they're a little bigger than you are, have certainly said that it will give them at least the seed money they wanted to go get the loan at the bank to grow. If not hire a person or if not buy equipment. talked to a number of companies that have said that. So they may be a little bigger than you are. They may be a little different than you are. You said you're a C Corp, I think you said? Yeah. Okay, so the small business thing doesn't pertain to you. What I would suggest to you is you go to the Department of Commerce in Kansas and ask about incentive and tax credit programs and try to be one of the 59.3% who pay no income taxes in the state of Kansas today and see if you can't get a better deal.
Right, but you think I may be an S Corp. I'm not really sure, because I don't worry about that very much. I just have my account, what I should do. He's told me that I'll get 6%.
Okay, so you must be an S Corp or an LLC.
But you guys believe that if you give guys like me, or guys much bigger than me who are getting $1 million pass through, and they'll save $60,000, that, or a $500,000 pass through, they save $30,000, that's going to entice us to go hire people.
Yes. I think the studies will show you that will happen.
Okay, we have time for one last question here, Charlie.
Secretary Jordan, this is for you again. Senator Holland did a good job of explaining the negative correlation between eliminating income taxes for the individuals and growing business. All we've ever gotten from the administration that I can see is a statement that says eliminating individual income taxes will grow businesses. I've never seen an explanation as to why this will happen. Can you give us a logical, believable, truthful correlation between why the administration thinks eliminating individual income taxes will grow businesses?
I think there's a distinction to be made. Number one, individual income taxes, the flow-throughs do pay through individual income tax. So yes, we're saying through that there'll be some growth. Some businesses will grow in the state of Kansas. They pay, flow-through means individual income tax. So that's part of it. On the personal side, on you as a person or me as a person, I would not say in front of you today that it's going to grow jobs, but it's going to grow the economy. When we put more money in your pocket and more money for you to either spend or invest or to save, it will help the Kansas economy. And so you've got one hand, you got flow-throughs paying through an individual. We think that will, as I just said, grow the economy. On the other hand, you got individuals, low income to high income, who will have more money in their pocket to do what they want to do rather than the government having it. The other line the governor said is, I trust you more than I trust the government. The gentleman asked me about distrust of government. I'm not one of those, by the way. So, it's hard to lump conservatives. I think Tom would tell you I've tried to be a pretty even-minded guy in trying to get things done. I co-authored the Bioscience Initiative for the state of Kansas. Was big in K-Tech, and I just, by the way, sat on a panel with high-tech startup companies, some very involved with Google, who were very pleased with our flow-through policy for small business this year. And our angel investor tax credits. I helped write that bill. So anyway, but to answer your question, the flow-through is individual income tax. We do believe that'll help grow the economy, and we do think giving people more money in their pocket will help grow the economy.
But how?
Wow.
Go ahead, Senator.
I appreciate your question. Let me just kind of follow up with this. And as I start off at the beginning, I think I said I have a lot of respect for Secretary Jordan because when he was in the Senate, he along with Representative Kenny Wilk, they did co-sponsor the KIGA Act. It got us some great things like the Bioscience Authority. But, and I'm not going to lump Nick in this category, but unfortunately, we've seen conservatism in this state and this nation. There has been a change in thinking as far as how we grow jobs. Because, and this comes straight from Art Laffer, it comes from Americans for Prosperity, it comes from places like the Kansas Policy Institute. You have firms out there, these organizations, these advocacy firms saying, the government shouldn't be involved in things anymore like KIGA. The government shouldn't be picking winners and losers. The government just needs to give us our tax dollars. Let the free market make the determination. And that's why I'm really appreciative that we're having this debate today, because that's really, in my mind, the core of the argument. It's like, does government have a proactive role to play in making target investments to grow jobs in the state? And what are some things that would be? Is that being sure we have a quality K-12 education that our kids can rely on? Does it mean we've got quality infrastructure, roadways in this state that we can move goods and product and services to market? Those are the types of things it means that we're having this debate on. Or should we just rely on the free market, you know, the Koch brothers, the Rex Sinkfields, and all those folks to make those decisions for us? I don't think we want to go down that path. And so I think it's a fine line we've got to strike as we go forward.
Just one last statement. I think, too, I think the debate, whether it's on the federal level or state level right now, is, and as Tom said, I'm not necessarily saying government's all bad. There's some things government does that are good and should be done. But we're in a debate right now. What grows the economy most? Government spending or private sector? And by private sector, I don't just mean businesses. I mean individuals. If you have more money in your pocket, you're better off than the government in a lot of cases. It can get too high. And I think the debate we're in right now is, how do you balance that? Where's the balance? We hear on the federal level, government's spending too much money. We got a huge deficit. They're way out of line. Fortunately, on the state level, we got to balance the budget every year. We can't print money. And you're seeing between the states and the federal government this great debate going on. What grows the economy? Is it government spending, or is it private sector having more money in their pockets, more businesses having some capital flow that they can go out and invest and grow their businesses with? That's the debate, and we all probably fall in a different place on it. But that's the debate that's going on, and I just am pleased you're all here because we got to be a little part of that debate today. And that debate will continue in legislatures and in the Capitol in Washington, D.C. for a long time.
Gentlemen, I want to thank both of you for spending this time with us this afternoon. It's terrific.
Thank you.
Thank you all for coming out, and I hope to see you. Look on the back of your program. I think it's a week from Tuesday night when we have the CEO of Sporting KC, Rob Heineman, here. We'll talk about selling soccer game tickets.